Hi everyone, it's Alex King at Session Capital Research here. It's 5 o'clock Eastern Time on Thursday, the 22nd of December for the benefit of the tape. Now, the topic of today's webinar is where is our Santa rally, which seems to be notable mainly by its absence. So quite a day today, most certainly a head fake day if you ask me. But what I thought we could do on the webinar today is just take a breath, right? Just step back. And I'm going to look at the four major indices. We're going to look at the larger degree, so zoomed out. We're going to look at the smaller degree, so zoomed in, and we're going to see where's our Santa rally. As always, we'll run live open mic basis. So if you have questions, points, anything at all, just unmute yourself on your side and shout. So let me just make sure that everyone is unmuted at my side. Yeah, done. And as always, you can type into the Growth Investor Pro members only chat room, and I'll see the question. I can read it out for people there. It probably won't be our longest webinar, this, and so if we have time at the end, if you have any questions on anything in the service market, any individual stocks, anything at all, it'll be a great time to do it. This will be obviously our last call before Christmas. We'll have another webinar a week from now, 29th, before New Year. We'll see how well attended that is. Some people take the period off. But as we approach year end, great time to discuss anything that's gone before or that's coming next year. Okay, so without further ado, let's do the disclaimer. So, disclaimer, this webinar is intended for US recipients only, and in particular is not directed at nor intended to be relied upon by any UK recipients. Any information or analysis in this webinar is not an offer to sell or the solicitation of an offer to buy any securities. Nothing in this webinar is intended to be investment advice, and nor should it be relied upon to make investment decisions. Session Capital Research, its employees, agents, or affiliates, including the presenter of this webinar or related persons, may have a position in any stocks, securities, or financial instruments referenced in the webinar. Any opinions, analyses, or probabilities expressed in the webinar are those of the presenter as of the webinar's data transmission and are subject to change without notice. Companies referenced in this webinar or their employees or affiliates may be customers of Session Capital Research. Session Capital Research values both its independence and transparency and does not believe that this presents a material potential conflict of interest or impacts the content of its research or publications. Okay, so let's start with the larger degree. Now, I know we always do this, and maybe it's kind of boring, but I think it's pretty useful to do, particularly on days like this where it's easy to get caught up in the craziness. Okay. Let's start with the Nasdaq, as the Nasdaq got so hard hit today, and let's just take a step back and see where we are. First of all, let's put some economic, some macro context here. We make no claim to any kind of macro expertise here. Everyone on Twitter is now a macro expert, and that's good for them. We're not. However, if you look just at the narrative of markets this year, what's the narrative? The narrative is very simple, right? Which is the thing that fueled markets from the COVID lows upwards, and from 2009 upwards, frankly, was two things. One, low rates, low interest rates, low cost of borrowing, and two, ample liquidity. So liquidity pushed into the system by the Federal Reserve, and that showed up in two ways. From 2009 to early 2020, that was principally bank liquidity. So it became very easy for banks to borrow cheaply. And if you were a hedge fund or any form of institutional investor, you could access large amounts of money, and you could access it cheaply. And given that low risk assets began to deliver basically no returns, institutions, funds started to chase higher and higher risk assets, which pushed up the price of those risk assets. And you can explain the 09 to 2019 rally thus. You then get COVID, crisis hits in the second quarter of 2020, and for a while, genuinely it looks like the economy might stop. We've commented about this before, about this being this was a credit risk, a credit scare, not an equity scare, much like 2008. And so the answer to no liquidity in the credit market is, again, an injection of liquidity by the Fed and other central banks around the world. And I think it's uncontroversial to say, well, probably that was overdone. Probably putting some liquidity in was a good idea, but probably having households with record net savings by the year end 2020-21 probably wasn't the goal, and having a whole bunch of people sat at home gambling on meme stocks and 0 days to expiry options also probably wasn't the goal. So it probably did get a bit crazy. That's a narrative on the way up. Narrative on the way down, very simple, which is a reduction in liquidity. Don't get hung up on just rates, right? It's also a reduction in liquidity. So there's less money made available to banks and less money obviously put in the hands of the consumer by the federal government, Federal Reserve government, whichever way you look at it, same source of money. And so the narrative in 2022 is less money in the system, more expensive to borrow, risk assets, price declines, less demand for risk assets, price down, simple. Okay, and the reason for the rise in rates and the reduction in liquidity, so goes the narrative, is really simple, which is inflation. So one thing that I think is true, and is well documented by the Chicago School of Economics, your Milton Friedmans and all these guys, is if you flood an economy with cash, people are going to spend more demand, prices up. If you remove cash from the system, less spending, prices down. And that seems to have played out pretty well over the course of 2020, 21, 22. The reason I think we didn't get rampant inflation from 09 to 19 is because the rest of the economy was in a deflationary mode, right? So outsourcing of manufacturing, outsourcing to China and other places, outsourcing of services to India and other places, put a lid on goods prices, services prices, and also put a lid on US labor prices, because if you're competing with an outsourced provider in India or Vietnam or wherever it might be, you can't ramp wage claims in the home economy very much. So that deflationary impact of globalization, I think, masked the inflationary effect of the flood of liquidity post 09. The world's now, you couldn't call it a very cooperative place right now. Most economies have higher tariffs and higher non-tariff barriers now than they did in the last 10 years. And so you have not so much deflation from outsourcing, you have reshoring of things like semiconductor manufacturing. That's more expensive to do in the US than it is in Taiwan or China. That's why they used to do it in Taiwan and China. And so you have, there's no deflationary counter to the inflationary flood of money. And that, coupled with the rise in rates and coupled with the reduction in liquidity, has led to the market sell-off this year. Okay. Now, if you look at the inflation data, you will see that inflation in the US PCI and PCE measures, CPI and PCE measures are coming down. That doesn't mean deflation at the moment. It means a reduction in the rate of increase in prices. And so you look at it two ways: the year-on-year number and the month-to-month number. So each time that comes out, there's PCE data tomorrow. Look at the month-to-month number. That tells you the short-term trend. It's like zooming in on a chart. It's coming down. GDP just came in at plus 3.2%, higher than expected, and all available data tells you the labour market in the US remains tight, as in jobless claims aren't as high as expected, job vacancies higher than expected, all of that. So what you have in the US, when you look at it from a distance, is a pretty healthy economy, right? It's got hit by COVID as everywhere else, but an economy growing at GDP at 3% for a developed economy is pretty good. It's about where it should be. 5-6% is overheated. 1% is too slow. Negative, obviously bad. But all the narrative now is, well, the market's going to keep getting worse because we're going to be in a terrible recession. Well, where? Where's the data for that? And so if you think, well, GDP is holding up well, jobs are holding up well. So contrary to the narrative of, there's all these layoffs, jobs are holding up well. If jobs hold up well, people have money and have confidence to spend money, and inflation's coming down. So GDP good, jobs good, inflation coming down, rate hikes reducing, and rate of withdrawal of liquidity we'll see, but probably reducing. So if someone can construct a bear argument from here, I'd like to hear it, because aside from recency bias and it's all been terrible, so it's all going to keep being terrible. I'm not quite sure what the bear argument is. I mean, there must be one, but I can't see it in macro data, and I can't see it in Fed policy, because the Fed may be slow to react to this, but that's just a timing matter. So at some point, the Fed has to react to the data that's in front of them, not the data they think might be in front of them. We'll see how that. Wait, 1 second, sorry. Someone in chat. Okay. So the Fed is likely to soften its stance soon. I don't mean an about face, I don't mean a pivot, I mean soften its stance. And if that happens, and you've got strong GDP growth and good jobs, and frankly a market that's sold off pretty hard, I'd like to see what the bear argument is. Okay, now with that in mind, let's look at the QQQ. So we've done this before, but let's zoom out, right? So from the December 18 low, this year, end of this year feels a lot like 2018, where the Fed was tightening, big sell-off into the end of Q4. Q4 OPEX hit, and then 2019 Q1 through to the end of the year just ripped. So wave 1 up, peaking just before COVID, wave 2 down, 78.6 retrace, perfect wave 2. Wave 3 up in the Nasdaq to the 2.618 extension of wave 1, wave 4 down. And look, this is technically really interesting, right? So the wave 4 bottoms pretty much at the 61.8% retrace of the wave 3 up. Okay, so that is a deep wave 4, deeper, as you know, than we thought it would be in this service. But with a bit of context, thinking about it a bit more, it's a big wave 3. So it was a pretty dumb thing to say, but it was a big wave 3, so it's going to be a big wave 4. And if you look, it's still way above the wave 1 high, right? Wave 1 high in the Nasdaq was 238, and the trough so far has been 254, 255 or something. So it bounces off this 61.8% retrace. This is the October low. It plunges. This is a weekly chart. Plunges beneath this, moves up, falls back down, bounces back off it at the end of October, moves up, falls back down, has yet to hit it. And although everyone will be, wailing in the streets today after the sell-off, fact is that if you look from the lows of the year to where we trough today, there you go, surprise, surprise. So that's a wave 1 and a 2 up, right? That's a 1 up, and yeah, that's a 1 up and a 2 down. So since the October lows, we've put a wave 1 up and a wave 2 down that bottomed at the 78.6 retrace of the move up from the lows. So again, that's normal, right? So if this pattern follows, then we should see a wave 3 move up here. And so that would again suggest that we're in the early stages of a wave 5 up. So from where I sit, we have macro data that's supportive of an improving market. We have a technical chart that's supportive of an improving market, including today's dump. And that's in the Nasdaq, which is the one, it's the index that's been the weakest coming out of the October lows, and it's been the weakest on sell-off days like today. So even in the Nasdaq, that looks like we were going to move up. Let's zoom in and let's do the smaller degree in the Nasdaq. So it's the S&P. Here we go. Okay, here we go. Okay, so this is the hourly charts that we post in the mornings. So here we have, okay, so this here is the October lows. Okay, so we put in a 5 waves up, 1, 2, 3, 4, 5 waves up. An ABC correction that dropped to a little bit above where we started there. And then 1, 2, 3, 4, 5 waves up again. Technically it works out pretty well. And then we've seen a correction since the mid-December highs. so far, again, if you look at where we're back down to, then let's just measure. So it troughed today a bit below the 78.6, retraced to the move up from this early November low, and then it moved back up above that level. So right now, again, you know, there's the lows for the year, 5 waves up, correction down, another 5 waves up, and a correction down. So they're brutal moves, but again, on the smaller degree, that's supportive of we're moving up in the larger degree. I mean, just to do a very stupid and dumb thing, but it's sort of relevant, which is, look, that's a support line, right? That's moving up. It's not moving up very quickly, but that is a support line. And you also, up here, if you want to, you can see a resistance line. I appreciate that's not a very sophisticated way to look at things, but this is just moving up and down within an upward moving channel. And the small degree wave charts, you know, respect more or less the extensions and the retracements that you'd expect to see. So Nasdaq's looking, again, positive today, notwithstanding. Let's do the Dow next. Because the Dow has been, as I said in chat today, the Dow's been an absolute beast. Let's look at, we'll use the DIA ETF in a large degree first. So here's the Dow. Okay, so this is tracks from the, I think the 2015 lows in memory. So we get a wave 1 high just before COVID, as per all the other indices. We get a wave 2, a dump down to the 78.6 retrace again, wave 3 up, shallow wave 3 really peaks at the 1.236 extension of the wave 1, a wave 4 dump that troughs between the 38.2 and the 50% retracement. And you know, if the market's going to zero, how come the Dow's done this? Right? How come the Dow has moved from 287 on the DIA for the year lows to a high of nearly 350 on this climb out of those lows, and even now it's only at 325. How come if the market's going to zero? So if we just look at the move that's put in off of the lows, there's a surprise. There you go. There's a wave 1 up and a wave 2 down. That's only retraced back to the 38.2 retrace. So frankly, the Dow could fall back down to 300 on the DIA, and it would still be looking bullish. So, and again, if you want to look at even now, the Dow, the all-time high on the DIA was 370. Let's call it. We're now at 325. So, I mean, it's not so very far from an all-time high. And yet, apparently, we're in the next leg down of a bear market. Well, I'm sorry, but I don't see it. Let's zoom in on the Dow. As we've been doing, we'll use the YM futures trading view. So again, for those of you that don't read those morning notes, and I can't imagine why, because they're deeply interesting and fascinating. We use the futures for the smaller degree because you get more continuous trading. Futures trading hours are not quite continuous, but not far off. So there's a small break over the weekend, but they trade round the clock between the Chicago and the Asian markets. And so you get a much better read on these smaller degree movements using futures rather than ETFs. And although there are some differences in how futures move versus ETFs, for our purposes here, it's not material. Okay, so this is the Dow. We have here the October lows, wave 1 up, wave 2 down, deep wave 2 correction, pretty much retests the October lows here. Big wave 3 up, right? It's the Dow, and it puts in a greater than the 2.236 extension of this wave 1. So that's a big move. It tells you that the Dow is going to rip up strongly out of these lows. Shallow wave 4 down, not even a 38.2 correction, and then wave 5 higher that it peaks at exactly picture perfect 78.6 extension of the wave 1 and 3 combined. Okay, so we then get a sell-off right? So we get a wave A down, which troughs at the 38.2 retrace of this five-wave cycle up off of the lows, and look at how it respects the fib levels, right? I posted this yesterday when it was up here. So it bounces off the 38.2 retrace as support. It bounces off the 23.6 retrace as resistance, and then today it comes down, not quite to, but almost back to the 38.2, and it's bounced hard again. So I mean, you can see that this is just programmatic trading, right? I mean, either that or it's the mystery of the RuneScape, right? But that's just programmatic trading. That's just algos, you know, etching out that channel, right? But again, this is very, very supportive of a move up still. The YM futures, I think it's the March contract, you know, could drop to, you know, even down to 30,000, right? And you would still be in a bullish structure, because you'd have 1, 2, 3, 4, 5 waves up here. That's a wave 1 coming out of the lows. And if you had a wave 2, even down to 30,000, 78.6 retrace, which is a long way down from here, you would still say it's just a normal wave 2. Nothing to see here. Move along. So again, there's no evidence here of a bear market. Now, the market might collapse tomorrow. Of course it might. Anything can happen. But as yet, you know, where's the evidence that that's going to happen? You know, it's not there in the Nasdaq yet. It's not there in the Dow yet. Let's look at the S&P. So again, we'll use the ETF in the large degree, and we use the futures in the smaller degree. Okay. Here's the S&P. So again, from the 2016 lows, I think this chart runs wave 1 high before COVID, wave 2 COVID correction, 78.6 retrace again, big wave 3, 1.698 extension for the S&P, wave 4 down, 0.5 correction for the wave 4, and again, just look at what's happened since. Okay, so off of the year's lows, it moved straight up. It hit resistance hard at exactly that 0.236 retrace. Again, you know, that's clearly not an accident. Moves down, moves up again, double tests that 23.6 retrace as resistance, can't push through it. So you don't know what's going to happen. It's going to fall back. And even today, on a great big, you know, sell day, it wasn't that much of a sell day in the S&P actually, but a big sell day, it doesn't quite make it down to the 38.2 retrace. So again, if you're going to measure off of the lows, and remember, you know, the great thing about these Fibonacci levels is they measure movement. So it's not just, oh, it went up, it went down. We're not just looking at abstract concepts. You can just measure the moves. That's why these things are so great. Well, from the lows, it retraced almost to the 61.8 retrace of the lows. So again, that tells you that we're still in a wave 1 and a 2. But nothing here yet at this moment that says this market's going to go south, that says this market, you know, is just going to keep on selling off. It might do, but there's no evidence for it yet. There's no evidence in the macro, and there's no evidence in the charts yet. There's sentiment, there's fear, there's all those things. There's the fear that, you know, Powell is single-handedly going to wreck everybody's 401k, but that's just sentiment and fear. It's not a fact at the moment. Okay, so for the S&P, let's look at the futures, zoom in. Same story really. So from the lows, we have wave 1 up, 2 down, 61.8% retrace. This is from middle of October. A wave 3 extension, wave 4 down, wave 5 up. And then let's just clean this up a little bit. If you look at where we've retraced to, this red ladder here traces from the year's lows to the most recent highs. It looks at the retrace. So again, we've yet to hit the 61.8 retrace. So again, if the ES futures fell even down to, you know, 36.50, you're still in what looks to be a bullish move. This is 5 waves up off of the year's low, so that's a wave 1. This would be a wave. This is in a wave 2. We're in down now. And again, this is just a normal wave 2 correction. This was a pretty quick move up off the lows. This is just a correction of that. Finally, let's do the Russell. I hate the Russell personally, find it very hard to chart. So I make no particular claims for accuracy on this. I really don't like it. In particular, if you think about how this is the, actually, sorry, it's TNA, let's use IWM, sorry. Okay, this is the Russell 2000 ETF, the IWM. It doesn't behave like other indices. So if you think, each of the Dow, the Nasdaq, the S&P, all of them have, basically the same chart going back 7 or 8 years or so. They extend and retrace a little bit differently in each case. The Nasdaq goes up the most and down the most, as you'd expect. The S&P less volatile, and the Dow is less volatile. You'd expect that. The Russell is just a mess, if you ask me. In particular, if we just look at the monthly chart here, the thing that's sort of weird and different about the Russell, let's just try and trace that together. Hang on. There we go. Let's remove that as well. The thing that's weird about it is how it behaves into COVID. Most of the indices from the January 2016 December 15 point put in a wave 1 high and then retraced, but didn't give up all of that gain. The Russell was really weak. And so what you see with each of the other 3 indices is you get a peak that's right before COVID, late 19, early 20, and a 78.6% sell-off. What you get with the Russell is, well, first of all, the peak comes in August 18, which is weird by itself. It doesn't make a new high in 2019, when all the other indices made a big new high. And then it dumps all of the gain it made between 2015 and 2018. It gives it all up. And so the trouble is if you're using this wave count, and obviously there's plenty of other technical methods, but if you're using this wave count, it's really hard to make any sense of it, because is that a wave 2? Really? I mean, it gives up pretty much all the gain. So, okay, let's say it's a wave 2. Looks like a pretty deep one to me, but let's say it's a wave 2. And then what? You've got a wave 3 like this. Yeah, I guess you could say that. So you could say, okay, that's a really, really deep wave 2. But I mean, you're pushing the limits there. It's not really. This is a new wave 1, really. But okay, let's say it's a wave. Let's say that's a wave 1, and a 2, and a 3, and we'll say, okay, it peaks at the 100% extension of wave 1. Okay, let's say now that we are in a wave 4 down. Let's check the retrace there. Okay, so it's sold off like the other indices between the 0.5 and the 0.618. Okay, so maybe, but it's this 18-19 behavior. They're not making a new high in 19 is weird, and the dump of the whole post-15 gain. The trouble is what I don't like about the Russell is you get a lot of downside, right? When trouble hits, it really hits. Look, but when the good times roll, it doesn't roll that much upwards. So you've got all the downside, more downside than the Nasdaq put in over this period, but you don't get the upside. And so in general, I prefer to stay away from it. And this is why. Anyway, if you look at the behavior so far, I guess you could call this, let's chart it out like this, a 1, a 2, I don't really believe that's a 2, but all right, 3, 4, and then if you were to make this argument, you'd go like this. You'd say, well, that will peak somewhere between the 61.8 and the 78.6 extension of the wave 1 and 3 placed at the wave 4 low, is what you would say. So you'd say you're going to get wave 5 somewhere between 256 and 281. So let's call it 256 because we know you don't get much upside. So let's say the wave 5 is just above the wave 3 high. So there's your Russell, not very exciting compared to the others. But we can go with that chart for our standing chart for now. It's not too bad. I just don't really trust that as a way to. Okay, so let's look at the smaller degree on the Russell. does respect these tools quite well in a smaller degree, I would say. So if you look at the path up off of the October lows, 1 up, 2 down, troughs down to 61.8, wave 3 up, peaking the big wave 3 here between the 1.618 and the 2.236 extension of wave 1, wave 4 sell off down to the 0.5 retrace, and a wave 5 up that peaks around the 61.8 extension of wave 1 and 3 combined. Okay, so that's not a bad 5-wave pattern. There's your green wave 1 up, and we're now in a wave 2 down. That's the red larger degree wave 2 down here. Let's just lose that for the moment. And where's it dropped to? It's dropped to 61.8, retrace bit below that, shot up, back down again, and pinged right up off again it today. So again, you would say this is just a normal retrace off of the move from the wave, move from the October lows. So again, even in the highly fearful Russell 2000 that dives to the basement at the slightest opportunity, it's just a wave 2 down, and it could even go down to 1700 on the futures here, and you would still say wave 1 up, wave 2 down, nothing to see here, move along. And so with each of the indices, if you step back, okay, none of them look like giving anyone a great gift for Christmas, but really, this just looks like the consolidation within normal parameters of the move up off of those October lows. It doesn't look in any way bearish to me. Now, of course, if we revisit, even if we retest the lows and move up again, that wouldn't be so unusual. If you think back to 2021, Q1 and Q2, we saw some sell-offs. So March 21, it dumped pretty hard, bounced up, and it double bottomed around May for many stocks. And the May low in 2021 held, and then it ripped up from there. May 21, sentiment was terrible. Everyone forgets that because the year ended so strongly. But sentiment was terrible in May 21. Oh, it's it's going to go to zero. It's all over. Blah blah blah. But it didn't. And so the path here, again, look at the macro, look at the narrative about why stocks were down. Look at the technical patterns you see across 4 different indices. They all make the same argument, which is, yeah, anything can happen. It might all dump tomorrow, but the evidence so far says wave 1 up off of the lows, the October lows, peaking around between the middle of November and early December, depending on the index, and then a sell-off into the end of December, but a normal consolidation pattern. 2 steps forward, 1 step back. That's what that looks like. Okay, let's take a break for questions. I appreciate that this is not a common or a popular point of view, but the whole world is bearish right now, and that's fine, but that's just sentiment and fear. And it might be that the whole world turns out to be right, but right now the evidence isn't in their favor. And so I think it's important just to sort of zoom out and put the alternative argument to yourself. You have to protect your accounts, of course. Use stops, use hedges, whatever you like to use. But zoom out and look where the trend may be going. Okay, anyone got questions, points, anything at all? I'm just going to make sure everyone's unmuted my side. Yep, so if anything at all that you want to raise, then just unmute yourself to your side and chat. Alternatively, type into the members chat room, and I can read the question out for everyone else to hear. I think it's all garbage, by the way. Please do say so. Make no claims on being right here. You just have to look at the evidence. Okay, deafening silence.
Oh, Alex, this is Scott. I'll take you up on anything at all. This is an administrative question, so if it's out of order, please let me know. I have a hard time understanding some of these emails I get about the pro service. I'm a full service member. I think it's premium because I pay like $2,000 a year. And I tried, this all got started when I saw an email about your 5 stock picks for 2023. And I tried to go.
Alex, did you see the email I sent you earlier today?
I didn't get an email from anybody today.
Okay, I definitely answered you about an hour ago, but I've had the same question from lots of people. So for everyone here, we run a few services. Okay, so the webinar that everyone is on right now is the Premium Growth Investor Pro webinar. It's a Seeking Alpha service. It's our top service. So if you subscribe to the full Seeking Alpha Growth Investor Pro service, then you're getting all of our best work. You get the most access to us. You get a real-time service. You get tech stock coverage, defense, space, market index, long-term trading, short-term trading, disclosures on staff personal account trades here. You're pretty much round-the-clock access to us. You get everything. Now, in addition, we run some low-cost services, and we run those predominantly on Substack. So we run a newsletter called Tech Select. We run a newsletter called Market Insight. Okay, so the Tech Select newsletter comes in 3 tiers. 1 free, which is mainly Blarney. 2, a low-cost paid one, currently $200 a year, which is basically some tech stock picks for members only. And then a pro tier that we just launched, what will be $1,000 a year, currently on offer at $500 a year. And that is basically tech stock picks, actionable ones, plus additional content, plus a weekly webinar. Not this webinar. We run it on Wednesdays, and it's tech only. We don't do any of this index stuff. We don't cover any of the space stocks in it. It's tech only. That's why it's cheaper. Market Insight is our other Substack newsletter. It's free again, which is just basically ramblings, or there's a premium version, a couple $100 a year, and that covers ETFs basically, and it's ETF picks. Right now, there's no pro tier in Market Insight. There will be in January, but not yet. But again, that is not this service. So a number of people read some of our Substack stuff and raise this question, which is, well, hang on a minute, you know, I'm confused as to what I do and don't get access to. If you subscribe to this service, Growth Investor Pro, you don't need any of our other services. You're welcome to sign up for them. You know, give us as much money as you like, of course, but you don't need them. And the cheapest way to get our best content is this service. The webinar that we gave in the Tech Select Pro service last night, which is a Substack service, low-cost service, because it had a catchy title, a lot of people were like, well, hang on a minute, well, we haven't seen that. So I posted the slides in that webinar in the chat room yesterday, a couple of hours after we gave it. And so again, there's no new news in there. If you remember here, you've had all those stock ideas already. You've got the live charts, you've got all of that. So just to be absolutely clear, we're very, very careful about how we segment what we do. The best service we offer, the best value service we offer is this one, full growth Investor Pro service. Substacks are basically a way for us to slice and dice content, offer it cheaply, and reach an audience that isn't on Seeking Alpha. That's it. If anyone's not clear about that, you know, ask again. I think what we should probably do is put a standing note in the Seeking Alpha service explaining that, because most Seeking Alpha providers don't do a great deal outside of Seeking Alpha. We're different because the Seeking Alpha audience is fantastic. It's a ready-made audience, and the Seeking Alpha platform is terrific. Full service platform, handle all the billing, customer service is great for us, all of that. Big pay away from us to Seeking Alpha, and so we get what we pay for, no argument, but big pay away for us. Substack's a different world, which is it's much more DIY on our side. We have to do much more work, all the marketing, all the back office stuff we have to do, but it's a smaller pay away, and it's a way to reach an audience beyond Seeking Alpha. That's why we run it. So just think like any business, it's just reaching different audiences, multiple service lines originating from much of the same work, but that's what we do. So Alex, I did send you an email on this about an hour or two ago, so you should see that in your inbox, and I included in that a link to the webinar you're concerned about. So honestly, if I don't need to do if anything I can do to put anyone's mind at rest, this is the top service, this is the best value.
Yeah, well, that's helpful. So it sounds like these other services don't get something that we don't get. That was my...
No, absolutely, categorically not. No, what we are paranoid about not messing up like that. Okay, because the full service Growth Investor Pro package here, this is our it's the thing that built our business to begin with. It's the premium service. It's where I spend most of my time, frankly, during the day, and we would do nothing to undermine that. We'd be crazy to. But what we obviously do want to do is reach an audience beyond Seeking Alpha, and reach an audience at lower cost. And frankly, you know, from us as a business, an audience at a higher margin. You know, we make higher margins off of Substack because there isn't the payaway to Seeking Alpha, but we have to do more work in exchange for it.
Okay, well, thank you for that. I appreciate it.
No, not at all. Just to confuse everything, by the way, but to finish off, we also run a really basic newsletter on Seeking Alpha, which has been a rip-roaring success. So that's basically a couple $100 a year. I think it's $50 a year starter rate at the moment, and that basically takes a couple of articles from the service here, and it's just a really simple published newsletter. Folks get to read it, and so that's our other service. But that is, you know, if you have friends, family, people that like to read stuff occasionally, you know, by all means recommend that to them. But that is a really simple, basic service. And the goal of that for us and for Seeking Alpha, they asked us to join the launch group of that is, there's, you know, a huge number of people on Seeking Alpha that haven't, you know, paid for any content and don't like to pay for any content because they look at a service like this one and go, well, hang on a minute, you know, thousands of dollars. I don't think so. How do I know if it's any good or not? Well, I'll take a free trial. You know, I haven't really used it. So there's a big stumbling block to getting people to pay for anything. And so Seeking Alpha's logic is if we can offer a really low cost service to get people over the road bump of paying for anything, then probably it can be a big revenue spinner by itself, and probably it can lead to many upgrades into the service. And we found that. So we've got the, I think I'm right in saying, the most successful newsletter on the platform. It's been a huge success. And we've had many people upgrade from that newsletter into our main service. But again, there is absolutely nothing that's in that service that isn't in the full service. So if you're here, if you're paying for Growth Investor Pro, the full package, you're getting the gold standard, and you always will do. Absolutely no plans to launch a service that's superior to this. We dabbled in the past with fund-specific services, but the trouble is, we tried it a couple of times. The trouble is the revenue numbers look big for us, but they're not that profitable because each fund thinks they're getting, you know, an outsourced analyst service, and you know, that's not how we work. We run on a one-to-many basis. So we tried that a couple of times. No doubt we'll try it again in the future. But these one-to-many services are what work for us. Anyone else got anything on anything at all? Anything to do with our lines of business? Mark, I've got a couple of questions in the chat room that I'm going to read out. Do we have any views on the dollar or the euro? No, solely because it's, you know, just not an area that I personally or we as a firm have any DNA. Adam, who runs our Traders Perspective chat channel, who's on the call now, I think, did a great job introducing, you know, watching the DXY in the service and, you know, looking at that relative to equity movements. So in this group, as far as I know, Adam's probably the most knowledgeable, but as a house, no, not at all. But I mean, I look at it, but I look at it as a result of the things that Adam has said in the service.
Hey, Alex, can you hear me?
Yeah.
I just want to say to that, whoever asked that question, that was a great signal for us to be able to track opposite movements for the equity indexes, especially the Qs, the Nasdaq. I've found as of late, it seems to have decoupled from the market, and it's just not a reliable indicator, at least right now. I think we've gone from inflationary fears to recessionary fears, and that's a whole different thing with the dollar. So that's just my take on it, since I'm the one that kind of identified and was following it for that period of time. So
thanks, Adam. Mark's just typing on it. Okay. Yeah, you're welcome. There are many dollar experts, but none of them live here. Anyone got anything else, folks? Okay. All right. Well, look, you know, pretty crazy day today. You know, we'll see what happens tomorrow and the remaining trading days into the year end. Most, I think, professional fund managers are probably not doing much work right now, so I would expect to see that. I would expect volumes to be reasonably low over the next coming days. I'm not sure that what happens in the next few days is representative of what's going to happen in Q1. We've got you know, quarter end valuations that fund managers will want to get through as well to try and wrap up the year as well as possible. So let's see how the year ends and let's see what Q1 looks like. I would say that 2022 has been, yeah, it's been a difficult year, but also speaking personally, for myself as an investor, massively more successful and skillful investor at the end of this year than at the start. And I think in the service as well, we've gone from being, you know, doing a few things that we did quite well in 2020 and 21, 2019, to, you know, a much better service here now than last year. And that's in large part thanks to, you know, members of the community who have stepped up and now provide, you know, content. So that's Yimin, who's not here today, but does such a great job with the Federal Reserve analysis. Jay on the options front, Adam on the options and trading front, Karen, who writes for us as regards option movements and market movements in general, and many people in chat who are, you know, very active, great contributors to the service. And so I think we're in a much better shape now than a year ago, and that's in large part thanks to everybody who, you know, worked so hard to, you know, drag the community along and help everyone make more money. So it's a delight to run this service. It's an absolute joy to run it. Always fun, never feels like work. So thanks everybody for being a member here, and thanks in particular to those of you who work so hard to generate content for us. So have a great holiday, everyone. We'll do this again next week, and see you in chat later on tonight and tomorrow. Thanks a lot, everyone.